Dipan, the start to the September series has been on a nervous note, and even the data which is coming out of the developed markets looks a little bit sluggish. What's the call on the markets? Are we in for a correction?
We are in a correction actually, and I think that maybe this month could see the losses kind of deepen as compared to what we have seen over the past 2-3 trading sessions. But this is more like a normal technical kind of a correction, and I don't expect that it's going to add up to anything significant. In fact, we are getting more and more convinced that this outperformance which we have seen over the past few months will continue well into the rest of the year and next year as well. And although there are a lot of comparisons between this outperformance and what we witnessed in 2007, but there are two major differences which are being ignored. One, of course, is that in 2007, that is October 2007 to perhaps Jan 2008, we had rising oil prices and FII selling. Whereas this time around, the outperformance is on the back of heavy FII buying, and the fiscal picture and the economic picture for the government is steadily improving because of lower commodity prices. So I think that over the past few months, the long-term scenario for India, Indian economy, Indian equities, corporate India has improved significantly, and that kind of gives us the conviction that even going forward, the markets will continue to rally vis-a-vis the other global markets. But I think this month may be a bit dicey.
Dipan, afternoon. You keep an eye out on market internals as well. Is it a heavy market or an over-leveraged market? Is that what you think will lead to a bit of a correction, or will it remain the global frontier?
I think what will cause the correction perhaps over the next few trading sessions is negative FII flows. And the market internals are okay. It's not that they are heavily leveraged or under-leveraged. They're just about normal. What one needs to keep in mind is that these days a lot of the trading activity and the positions have got shifted to the options market. And kind of trying to, understand that what the options market is saying is a bit dicey and a bit difficult to gauge. Unlike the futures market where we looked at cost of carry and absolute open interest positions and could arrive at some conclusion whether the market was over leveraged or not. The same kind of studies are not possible in the options market. But my sense is that given that the implied vols are at extremely low levels, as also the fact that a lot of proprietary books of the brokers are now being deployed in what is called as delta arbitrage or delta trading, my sense is that I think that the futures and options market is not that leveraged. It is just about average levels, and the positions over there are not going to cause a trigger for an upside or a downside. I think the key number to watch out for, which we watch every single day, of course, is the FII flows in the cash market. And also do keep in mind that again we are seeing pickup in QIPs and IPOs and fresh issuances. So some of the FII flows which normally would have got diverted to the secondary market will find themselves into the primary market. So it's getting into a bit of a tricky situation for the immediate short term. And the kind of excellent run which we have had over the past 2 months, where FII flows just went into the secondary market, that picture seems to be changing. But as I said, I think it's just a minor blip. And I think that if FIs were selling and the markets were to see a correction of 8-10%, I'm quite optimistic that HNI, retail money, domestic mutual funds, insurance companies will certainly step in at lower levels, given that they have been the largest suppliers of stock over the past 2 months for all the FI buying which has taken place.
You keep an eye on these pharmaceutical names. Anything that's still worth a look or a buy?
No, I think investors are best off with the 3 large pharma companies. That's Ranbaxy, Dr. Reddy's, maybe Cipla, Lupin also could qualify for that. The business models are far superior than some of the other smaller size pharma companies. And I think that the generic market opportunity is now, reaching its absolute takeoff stage. And over the next 12 to 24 months, we will see fantastic growth in profits of the large pharma companies which are operating in the US market. That assuming, of course, that Ranbaxy is able to get its US FDA approval in place so that they can start exporting to that very key economy. Having said that, I think that this entire Piramal deal has brought in renewed interest in the entire pharma sector, and the kind of valuation in which it was done, I think that it's not difficult to understand why the sentiment for a whole host of mid-sized pharma companies have improved, and on and off we do hear rumors of a particular company up for sale or doing some deal or some strategic kind of a tie-up. And I think that will take place in the pharma industry. But for the timing, I think we are seeing some of the mid-cap pharma companies, getting a bit on the overvalued zone, considering the kind of business model which they have. But large-cap pharma, I think, will continue to find favor with the institutional investors, and they could prove to be outperformers or even perhaps get leadership position over the next 6 to 12 months or so.
Dipan, the big bulls of the last series was the entire oil marketing companies. So you had BPCL up 20%, HPCL up about 25%. Do you think they can generate more returns from here on? Because the buzz is getting louder for deregulation with lower crude prices.
See, we're very positive on the entire oil marketing space, but as things stand, and it could change, of course, as things stand, the deregulation is only in letter and not in spirit. And we are seeing still a lot of covert interference from the government in the pricing of oil products, and oil marketing company executives are under pressure not to raise end product prices, and they're not given full freedom to operate in the way they would like to. Maybe it's a transitionary phase, and maybe 6, 8 months, 12 months down the line, hopefully if oil prices remain stable to decline, then more autonomy may be passed on to the oil marketing companies. Because one thing is certain, that if these oil marketing companies have full autonomy, then the kind of profits which they can generate and the revenues which they can, return on investment which they can generate would be quite fantastic, and these stock prices could double or triple from these levels. Intrinsically, these are companies which have got very high entry barriers. The business per se has very high entry barriers, and the kind of network and distribution which has been put up is impossible to replicate. So they would be in a position then to extract the full benefit of all the hard work they have done over the past 40, 50 years in setting up a distribution network. Those returns will start coming in if more autonomy is given. But if the government continues to intervene and they are not able to increase end product prices the way they would like to, then I think the run which we have seen up till now is more or less done with, and one should not then kind of expect a fantastic growth in bottom line. Of course, one-time growth will come because of the adjustments which have taken place in diesel, kerosene, the petrol prices. That one-time adjustment will take place in the current fiscal. But then going forward, I don't think that they will be able to incrementally grow their profits. Do keep in mind that on the whole, the volume growth is not that spectacular in the entire oil industry, whether it is refining or marketing. So that's not going to be a major kicker for profit growth. I think it's more to do with margin growth for the oil marketing companies as and when that takes place. And that will happen only when they have more autonomy and more independence.
Well, as